The average dividend investor is handing the IRS 15 to 25% of their returns unnecessarily, and they have no idea it's happening. I'm Marcus Hale. 15 years ago, I was managing equity portfolios for institutional clients, and I noticed something that completely changed how I think about dividend investing. The investors making the most money weren't the ones chasing the highest yields. They were the ones who understood taxes. Last year, I reviewed the portfolio of a client who'd been investing $500 a month into dividend ETFs for the past 12 years. On paper, she looked like she'd made the right moves. She'd invested in funds with solid 5% yields. But when we did the full tax accounting, we realized she'd paid nearly $47,000 in unnecessary taxes over that decade. Nearly 18% of her total portfolio returns had evaporated to the IRS, not because she broke any rules, but because she didn't structure her accounts correctly. Here's what she should have done differently. And more importantly, here's what I'm going to show you today so you don't make that same mistake. Let's start with the misconception that's costing most dividend investors serious money. The idea that dividend yield is everything. When I was still managing portfolios, we had a saying, yield blindness. It's when investors fall in love with a number on a fact sheet without understanding what happens to that money after taxes. A 5% yield looks amazing until you realize you're paying 37% federal tax on that income, plus state tax, depending on where you live. Suddenly, that 5% is closer to 3% in your pocket. And that's before we even talk about the fees eating into your returns. So let me show you what actually works. And I'm going to use 3 specific ETFs I've recommended to clients because they balance yield, tax efficiency, and real-world simplicity. First, the Schwab U.S. Dividend Equity ETF. This fund has a 0.06% expense ratio, which is incredibly low. More importantly, it's been yielding around 5% over the last 12 months, and here's why I like it for tax planning. It focuses on dividend growth stories, not just high-yield traps. The fund screens for companies that have increased dividends for at least 10 consecutive years. That means you're getting companies with pricing power, stable cash flows, and less volatility. In my experience, less volatile stocks mean fewer tax loss harvesting opportunities, but the dividend is more stable and less likely to be cut. That matters more than people realize. Second, VIM, the Vanguard High Dividend Yield ETF. VYM has a 0.08% expense ratio and currently yields around 2.9%. Now, that's lower than on the surface, but here's where most investors miss the tax angle. VYM holds more large-cap dividend payers. Think Procter & Gamble, Johnson & Johnson, Coca-Cola. These are mature companies with qualified dividends, which means the IRS taxes them at long-term capital gains rates instead of ordinary income rates. That's a massive difference. Qualified dividends max out at 20% federal tax for high earners. Non-qualified dividends, they're taxed as ordinary income, which can be 37%. That 17 percentage point difference compounds dramatically over time. Third, JEPI, the JP Morgan Equity Premium Income ETF. This one's different. It yields around 8 to 9%, which sounds incredible, and this is critical, much of that yield comes from covered call writing. That income is taxed as short-term capital gains in most cases, which means ordinary income tax rates apply. I use JEPI differently than SCHD or VYM. It's perfect for tax-deferred accounts like IRAs or 401(k)s, where the tax treatment doesn't matter. But in a taxable brokerage account, JEPI can create a tax nightmare if you're not careful. This brings me to the account structure strategy that actually made the difference for my client. When I reviewed her situation, we completely restructured her 3 accounts: her 401(k), her IRA, and her taxable brokerage account. Here's what we did. In the 401(k), which was getting about $11,000 a year in contributions at that point, we loaded up on JEPI. Remember, she's not paying any tax on the distributions inside the 401(k), so getting that high yield working for her made sense. 8 to 9% yield on $80,000 grows to about $6, $400 to $7, $200 in annual distributions that we're reinvesting tax-free. Over 12 years, that's a huge difference. In the IRA, we used almost exclusively. Traditional IRA means no taxes on dividends until withdrawal, and dividend growth focus meant the underlying portfolio was compounding faster than a pure yield play. When I worked through the math, growing at an average 2% per year, 5% yield plus historical capital appreciation compounds better than a higher yield, lower growth fund. In the taxable brokerage account, he split between VYM and SCHD, emphasizing VYM because of those qualified dividends. That's where we also implemented tax loss harvesting. Now, tax loss harvesting is where most investors either don't do it or do it wrong. The concept is simple. When a position loses money, you sell it to realize the loss, which offsets capital gains elsewhere in your portfolio or up to $3,000 of ordinary income per year. But the IRS has the wash sale rule, which prevents you from buying the same security back for 30 days. Here's the tactic that works. Let's say VYM drops 8% in a market correction. You sell VYM at a loss and you immediately buy SCHD. Both funds focus on dividends. Both track similar market segments, but they're different securities, so the wash sale rule doesn't apply. You've locked in the loss for tax purposes, but you've maintained your dividend exposure. 90 days later, when the wash sale window closes, you can swap back if you want to. In my client's case, we did this 3 times over 12 years, capturing about $8,200 in tax losses that offset her capital gains from the few individual dividend stocks she owned. That $8,200 in losses, at her marginal tax rate of 32%, that saved her roughly $2,600 in federal taxes. Add state taxes, and you're looking at nearly $3,400 saved from one strategy she had no idea about. Let me show you the full math on her portfolio. Starting in 2012, she began investing $500 per month. Let's assume she started with $20,000 already saved. Over 12 years, that's $500 times 144 months, which equals $72,000 in contributions, plus her initial $20,000 for a total of $92,000 invested. Gross returns on a dividend portfolio averaging 7.2% annually over that 12-year period, accounting for the dividends reinvested plus capital appreciation, would have turned that $92,000 into approximately $181,000 before taxes. But here's where the tax angle kicks in. In her original approach, all in taxable accounts, not optimizing for qualified dividends, not tax loss harvesting, her after-tax value would have been around $147,000. That's a 19% reduction from the gross returns due to taxes. With our optimized approach, maximizing qualified dividends using tax loss harvesting, placing high-yield funds in tax-deferred accounts, her after-tax value hit $172,000. That's a 5% reduction from gross returns instead of 19%. The difference between $147,000 and $172,000 is $25,000. On a $92,000 investment over 12 years, that's not trivial. That's an extra 27% of growth that tax optimization created. Now, I want to show you one more layer that most advisors completely miss: sector concentration and its tax implications. In 2024, technology stocks represent roughly 28% of the S&P 500 by weight. When it was released, it started overweighting financials and healthcare, lower tech allocation by design. That's intentional. Why? Because technology stocks have higher capital appreciation and lower dividend yields. VIM, on the other hand, actually leans into that tech weight, which means higher capital gains distributions if the fund has to rebalance. Those are taxable events. When I structured my client's portfolio, we used this to our advantage. It became the core holding in taxable accounts because it naturally generates fewer taxable events. VYM, we saved more for the IRA where the rebalancing tax doesn't matter. This sounds like a small detail, but over 12 years, it meant she was realizing long-term capital gains instead of short-term ones. Long-term capital gains get a 15% federal rate for her income bracket. Short-term gains would have been taxed at 32% ordinary income rates. That 17 percentage point difference, multiplied across multiple rebalancing events, added up to thousands of dollars. Here's what I want you to take away from this. First, don't chase yield. Chase after-tax returns. A 9% yield that's entirely qualified dividends in a taxable account will beat a 5% yield that gets taxed as ordinary income every single time. Second, your account structure matters more than your fund selection. I could have put my client in perfect funds, but if all the money was in a taxable brokerage account earning high non-qualified dividends, she would have left tens of thousands on the table. The fact that she had a 401k, an IRA, and a taxable account meant we had the flexibility to optimize. If you only have a taxable account, you have fewer tools. But that's why you need to know about qualified versus non-qualified dividends. Third, tax loss harvesting is not an advanced strategy. It's table stakes for anyone with more than $50,000 in a taxable investment account. You're literally leaving money on the table if you're not doing it. And fourth, this is the one that surprises people. Don't assume higher expense ratios don't matter. JEPI expense ratio is around 35%, which is higher than SCHD 0.06%, but that 0, 29 percentage point difference is worth paying in a tax-deferred account because the 8 to 9% yield more than makes up for it. In a taxable account, that higher expense ratio plus the tax drag from the fund's internal structure means you're probably better off with SCHD or VYM. I know this is dense. Let me simplify. If you have under $100,000 and only a taxable account, core position in SCHD, maybe 20% in VYM. Simple low taxes, low fees. If you have a 401k and a taxable account, JEPI in the 401k, SCHD in taxable. If you have the full suite 401k, ERA taxable account, JEPI in 401k, SCHD in ERA, VYM plus split in taxable account with an annual tax loss harvesting strategy. That's the framework I've used with clients for years. Not because it's complicated, but because it works. One last number. Let's say you implement this strategy and you're able to improve your after-tax returns by just 3%, from 18% tax drag to 15% tax drag. You invest $500 a month for the next 25 years. At an average 7% real return, you'd accumulate approximately $287,000. If you hadn't optimized for taxes and stayed at that 18% drag, you'd have $263,000. That's a $24,000 difference for zero additional risk. Zero additional effort, really, once the structure is in place. That's what tax-efficient dividend investment